hope is a data point, but what should we expect with respect to direct taxes? Is there anything on that front?
Oh, yes. A couple of things. Once again, I mean, the direct tax world is very sort of somber, saying this is the vote on account. Don't expect much, but expect a directional intent on matters that are really important. So I won't spend more time talking about, the personal income tax, because those changes we've already discussed over here. But the rationalization of the capital gains regime is a reform that the industry has been asking for a long time. There are so many different asset classes. There's listed equity, unlisted, equity. There's property, and then of course there is the debt side of it, and even the definition of long-term and short-term, that varies across asset classes. The rates vary. Some of the asset classes have indexation benefits, some don't. So it's very, very confusing. And the industry has been asking for a rationalization. In fact, I just want to put out the table that CII has put up as a proposal. They're saying make it very, very simple for financial assets, whether it's equity or debt. Simplify this. Just make the holding period long-term as 12 months, anything above 12 months long-term, anything below short-term, and then rationalize the tax rates, 10% for long-term, 15% for short-term. I mean, that's sort of some advice that they're going with, and likewise streamline it on the property side as well. But beyond this, the biggest expectation is, and the hope is, that if India is to be this manufacturing powerhouse, then the concessional rate of 15% that India is giving for new manufacturing companies, there should be an extension, because right now that manufacturing unit needs to be set up by the 31st of March 2024. That's the current sunset. So the expectation is the government will increase this by at least 1 year so that new manufacturing units can continue to get the benefit. And then two more very important sort of thematic changes from a tax policy standpoint. One is rationalizing a very complex withholding tax regime, TDS. There are, about 30 sections, and the TDS rates vary greatly as well. So the expectation is, or the demand is, that if not in this budget, but in the next one, start rationalizing this regime as well, narrow it down to 2 or 3 rates, and just make a very small negative list. So simply paying those taxes and withholding those taxes becomes simpler. And I want to end with something on global taxation, because it's very, very important as well. There is the base erosion profit shifting concept, the BEPS global tax framework, where India is a signatory. World across, over 40 countries are moving on what is known as Pillar 2 of BEPS. What does Pillar 2 say? That there needs to be a minimum 15% tax on all global companies in every jurisdiction in which they're operating. Now, India has not yet stated its position. It's expected to join in, but it's not come out with a clear policy framework, because that will, involve an amendment of our current tax laws as well. The industry is really holding on with bated breath to know how this rolls on, because the expectation is 2024, India should move towards this regime. It's favorable. It'll probably get the tax department to, earn more tax revenue by taxing a lot of the companies which are operating in these various jurisdictions. So that's also something which is a watch point. Last but not the least, to wrap it up in terms of focus areas, AI and green energy or green transition, these are the big focus areas across industry. Expectations are that maybe, these two sectors will get some sort of tax incentives to sort of improve the manufacturing thrust over here. Back to you.
Oh, absolutely. And green energy has been a big focus area for the government, right? So won't be any surprises if there are tax incentives there as well. With that, it is curtains down on this edition of Halftime Report. Thanks a lot for watching.